Mark, thanks very much for joining us this morning. When we started 2018, at the beginning of the year, and I remember this distinctly when I was in Davos, everybody seemed rather bullish about what the year would turn out to be in terms of global economic growth. Yes, there were some trade concerns, and yes, there was the expectation that this was not going to be like 2017, that volatility would return to global equity markets. But nobody had anticipated this kind of first half. As we come to the close of the first half, where and how do you think that sets us up for the second half of this calendar year across global equities?
My best guess is that we will be down rather than up during the summer months, but I may be contradicted by what you just showed, this interesting data about a summer recovery in India. In the United States, it's different. People tend to go away on holiday, and therefore the market is quiet. And when it's quiet, bad news tends to have a bigger impact. And I think that what we knew at the beginning of the year about the trade war has changed in the sense that we thought it would just be a quarrel, and it's clearly evolved into something different. And so if you just look at the numbers as they are now, it shouldn't cause that much of a dent in various economies. For example, Trump is talking about a 10% tariff on $200 billion worth of Chinese imports into the United States. Well, that's $20 billion. On a $13 trillion economy, it's a speck of dust in the universe. But the problem is that we're starting to see now showing up in data this uncertainty is flowing through into, for example, when I look at new orders to inventories, they're falling sharply in countries around the world. A clear sign that manufacturers are not placing so many orders because they're less confident about the future. So I think it's the confidence in the future that has caused this, sideways activity. What is supporting the market, the reason it's not going down, is the tax cuts will be responsible for earnings growth in the United States of about 20% this year, which absolutely phenomenal. So by the end of this year, the S&P will be on 15 times, which is actually not expensive.
Do you reckon that much of the pain that we've seen in global equities, also emerging market equities, is due to the uncertainty thanks to the trade frostiness that we're seeing at this point in time, or is it mostly the world coming to terms with the fact that the easy money policies of central banks across the world are now finally coming to an end, right? I mean, we've finally seen that commitment come in from the ECB. I know that BOJ is still sort of outside that pool of slightly tightening central banks, but are we finally coming to terms with the fact that the cost of money is going up?
We are.
And therefore, that's the bulk of what's playing out.
Yes. All these things are linked, actually. So you bring up an extremely important point, which is the interest rate cycle. And ironically, it's been accelerated by the tax cuts because the second quarter growth rate in the U.S. will be at least twice what it was last year, probably about 4.8%. Right. That's an incredible number for the United States economy. And when we look at various inflation gauges, forward-looking inflation gauges, I would cite in particular the New York Fed's recently launched underlying inflation gauge. It's clearly showing us that there will be higher inflation rates 6 months from now than there is today. So yes, as the cost of capital rises, it makes risk assets look relatively less attractive.
Okay. Also, it was the year that we expected that the U.S. will pull everyone ahead. You spoke of second quarter expectations. We've seen a minor downward revision in the first quarter number in terms of U.S. GDP growth from 2.2 to 2%. Those were the numbers that came in late last night. I'm just curious whether you think that strong growth in the second quarter in the U.S., possibly even in the third quarter as a result of those tax cuts, will be enough to keep the global economy chugging, or will it be countered or neutralized to some extent by the stance that the U.S. has taken on trade?
Well, also an extremely relevant and important question that I have no answer to. Okay. But you're absolutely right that this trade war talk and the rising interest rates, and I might add the stronger dollar, because one thing I would diverge in opinion with you on is that I don't think the ECB and the BOJ are tightening. In fact, the ECB said 2 weeks ago, we've changed our mind. We were going to raise rates in the summer of next year, and now maybe at the end of next year. Yeah, I think these countries are starting to purposely weaken their currencies to have some kind of buffer against the potential impact of higher tariffs from the United States. So anyway, yes, it is possible that the very healthy growth rate that that we had assumed for the full year, which is approximately 4% for the world economy, will be less strong. But I mean, even if it ends up at, I don't know, 3.7, 3.8, actually, if you look back in history, that's still about 50% higher than the average of the last 20 years. The world economy is still growing at a very healthy clip.
Oh, yeah. Sorry, I may have miscommunicated. What I meant was the Fed clearly is on the path of normalizing rates. The ECB has finally committed to doing that in starting September this year, at least in terms of pulling back its bond purchases. Yeah. And the BOJ is still outside that pool. It still hasn't decided or made any decision. But you made an interesting point about currency weakening, and I know I've seen this chatter pick up over the last couple of weeks that are we seeing this trade war move into a currency war of any sorts? I'm going to also bring up what's gone on with the yuan in the last couple of weeks. Now, I know that isn't intentionally what China's trying to do, but they've allowed for that devaluation to take place. There is some intervention now, but nonetheless, it has been a sharp devaluation over the last several days.
I think it is intentional. I do.
So
it's a little signal to the United States. We have alternative. Because what we're starting to understand actually is what China does buy from the United States. It needs. It can't do without. We saw that in ZTE. So they can't really respond in kind with the tariffs. They need the Boeing airplanes, they need the soybeans, they need the cars. And they can't necessarily stop purchasing treasuries or start selling them either, because that would cause a major appreciation in the renminbi. So allowing the renminbi to go down, I think, is a little signal that that they have alternatives. And I'm not sure how far they'll let it go, but yeah.
Okay, that sets us up in terms of what the context is. What does this mean for India? We've seen, we were calculating this Jan to June outflows, both from foreign investor outflows, both from debt as well as equity, at their worst in 10 years here in India. What is the outlook on India in the context of all of this?
Well, I think the nice thing is we didn't even mention India once, because we're all talking about bad things, and India is not part of the conversation. So it's lovely that it's insulated in that way. I still have fresh in my memory the tremendous collapse in Indian share prices in 2008. And so I remember at the time, I have to admit, I was one of the people saying this, that India is insulated because it's a strong domestic economy, and it wasn't. It went down with the rest of the world. So if there's a big bear market, of course a global bear market, India will be part of it. It's an open capital market. But here's where I think there's pros and cons. So the pro is that if we do get a mild deceleration in global growth, it will probably help bring the oil price down, and that would be helpful to India. The con is that if the dollar continues to go up, then people won't really want to buy Indian assets because they'll be worried about losing money in the currency. So those kind of cancel each other out, and now we're back to zero, we're square. And then I think you just add up the pros and cons within India itself. And on balance, I think the pros outweigh the cons. So I haven't turned bearish on this market. I'm still overweight. It's a good market to me.
Okay. There is some commentary coming in suggesting that the sell-off we've seen across emerging markets, including here in India, actually makes for a great buying opportunity. Do you subscribe to that, or do you think there's too much uncertainty at this point in time for foreign investors to actually consider making a bit of a U-turn to this market?
I think it's too early, actually, yeah, for the broader emerging asset class, because a lot of these things that we discussed earlier, we don't have answers for yet. When will interest rates stop going up, and how much will global growth be impacted? Where does this trade war talk go? Either it's a negotiating tactic on the part of Trump to get a slightly better deal, or he genuinely wants to rewire the world economy. I actually don't know which one it is. I don't think it's impossible that it is the latter. I think he may genuinely want to change the way the world works since 1990, the so-called Washington Consensus. Anyway, I've got a little off topic. I'm sorry. Yeah. So the emerging asset class I don't think it even should be an asset class anymore. It was created in 1987 by a World Bank economist, and at the time it made sense to give third world countries a nicer name, so they called them emerging markets. But what China has nothing to do really today with Brazil or Mexico, etc.
So considering the headwinds, oil prices, the weakening currency, some of the macro concerns, the political issues here in India, do you foresee foreign flows to India actually turning positive in the second half at all?
Not really, no. I don't foresee that happening.
So there isn't going to be any fresh buying from foreign investors?
I would doubt it.
That they stay very cautious on India?
Yeah, but I'm not sure what the latest numbers are. My understanding is they've sold about $1 billion so far this year of Indian equities, which is extremely small.
You're looking at ETFs?
I don't know, actually.
Yeah, I think that is the ETF number, yes. We were talking about direct equity outflows as well. So, yeah, well, it's small in the context of, sort of the overall market. But nonetheless, just wanted to know whether the mood of foreign investors is likely to change with regards to India at all in the next 6 months.
If anything, I think it'll deteriorate because it doesn't look like these state elections are going to go very well in places like Rajasthan and MP. So I think the major preoccupation with foreigners is politics. And what's been interesting for me here is that I've learned Indians aren't particularly preoccupied by that. They are saying it doesn't really matter who wins the election next year, the economy will keep going. And I've seen numbers that suggest that there isn't a strong correlation between, pro-business or anti-business governments at a federal level and the stock market. Problem is, for the last 4 years, all the brokers have been calling us up and telling us how wonderful the BJP is, and the Prime Minister in particular. So we believe that. That's what we've been hearing for the last 4 years. And so now people are starting to tell us maybe it's not going to work out so well in the 2020 election. That has a lot of foreigners concerned. Okay,
the clients that you are meeting, are they positive on, let's say, individual business spaces, sectors in India? Because the macro is looking a little dodgy at this point in time, the political headwinds, the global headwinds, but is the micro looking positive? It's
looking very good. From meetings I've had so far, yes. There's very tight capacity in the industrial sector. Obviously, the weakening currency has significantly helped the IT sector. The banks, NPAs have definitely peaked and are starting to come down. There aren't many sectors that I see a negative outlook for, actually. So what has been the proposed or the investment strategy in India that you would have recommended in the first half? How has that changed in terms of stocks and sectors that you like? And especially after this visit, are you going to relook at some of those? I must confess that I have not really approached this market on a sector basis, and so I basically just want to be in it, and so I'd rather just say that I like the Indian market than try to choose specific sectors that I think will do better than others, because I think we can look back in history and say that nobody really saw the big collapse in the pharma stocks or the public banks coming last year. I find it difficult to predict which sectors are going to outperform others over the next year. I'd rather just say I like this market and I'd like to be in it.
What do you think will lead the market then? If you'd like to be in this market, what do you think? Because I heard you in a previous interview just a couple of days ago where you said you were structurally overweight on India. Is that correct?
Well, the definition of that is, I think in any portfolio there's a sort of structural part of the portfolio that you buy and hold. And then there's a tactical part that you weave in and out of. You're not really wedded to those things. They're opportunistic. And for us, India has always been a structural, it's part of our core portfolio. We want to buy and hold it.
Okay.
So it's not something we want to change our allocation to very often.
But would you be recommending to clients that they should add to their positions in India?
Absolutely.
Or
yes.
So where?
Well, of course,
in which areas would you consider that,
No, I don't. I'm sorry, I don't. Well, I think the banks and the consumer sector. As I said, I think the NPA resolution, short-term pain for long-term gain, and I think the short term is now coming to an end, and we can look forward to a healthy credit cycle. It's a little early to say it started just yet, but I think the light's at the end of the tunnel. And as I said, the consumer sector. Yeah, those two things, for example.
If the currency remains weak, would exporters be something that you'd look at? Pharma, IT?
Yes, they would. Yes, pharma.
Pharma's made a bit of a comeback in the last few weeks. So.
Yeah, they would be. But as
you sound hesitant.
It's not that I'm hesitant. It's just that I like the whole country. So I'd rather just be set up in the whole country than really. I guess, to be honest, I don't have the time to monitor each of the sectors as closely as I would need to if I was going to do sector allocations. So what we tend to do is we leave that to fund managers to make those decisions.
So, Mark, final question. You sound, if I may use the word, bullish on India. But you just told me that you don't think that foreign investor sentiment on India is going to change dramatically in the second half, which means that they aren't going to come back into any buying frenzy, seeing where the markets have come off. What explains that divergence in your approach and how the rest of the pack are approaching India?
Well, I wouldn't base my investments purely on the sentiment of other people. It's whether stocks basically stocks move on their cash flow anywhere in the world. So the cash flow in India will, I think, probably be, I don't know, 50% higher 3 years from now than it is today, the corporate profits. So on that basis, I like the Indian market. But I mean, just because foreigners aren't going to buy it in the next 6 months doesn't make me bearish on it. Locals, I mean, you still have the SIPs contributing about $1 billion a month, which is a material amount of money. But for the world markets, I do think summer will be not particularly interesting, probably down. And for the full year, I don't know if I would say with great confidence that it's going to be up either. But you know, I think we should look beyond that.
To next year.
Yeah.
How has the Mumbai monsoon been treating you?
I had a very rocky plane ride yesterday from Delhi, actually. Yeah.
All right. Well, I hope you have a good weekend here.
Thanks
very much for joining us here in studio.
I'm honored to be here. Thank you.